You're 28 years old. You've been grinding for 5 years. Your savings account just crossed $60,000. You found a condo, 2 bedrooms, good location, $380,000. Your mortgage broker is calling twice a week. Interest rates are favorable, prices are climbing. If you don't act now, you'll miss your window. Your older brother keeps texting you Zillow listings with comments like, "Stop making your landlord rich," and "You're literally burning cash every month." Your coworkers who bought places 2 years ago casually mention their home equity gains at lunch. They talk about tax write-offs and forced savings like they're financial geniuses. And you're sitting there with your $60,000 running the calculations for the 20th time. At 6.8% interest with 15% down, $57,000, your mortgage payment would be $2,158. Add HOA fees, $280 per month, property tax, $3,800 per year, that's $317 per month, insurance, $125 per month, and repairs and maintenance, even in a condo, $200 per month minimum. That's $3,080 per month before you've replaced a single appliance or dealt with a special assessment. You're currently renting a comparable unit for $2,400 per month. Your brain says renting makes more sense right now, but everyone around you is treating you like you're financially illiterate, like you're scared of commitment, like you don't understand wealth building. So you ask the question that's been haunting you for months: should I actually buy this place? And here's what the real estate industrial complex desperately doesn't want you to figure out. There's a dead simple formula to answer this question. It's called the 5% rule, and once you see it, you'll stop making housing decisions based on guilt and FOMO and start making them based on actual financial reality. My name is Caddy, and I spend way too much time reverse engineering the lies that cost people hundreds of thousands of dollars because someone told them rent money is wasted money. Disclaimer: I'm not a financial advisor. This video is for educational purposes only. Do your own research and consult with licensed professionals before making any financial decisions. Your situation is unique. Make choices that work for you. So if you're being pressured to buy property you're not sure about, or if you're trying to figure out whether buying actually makes sense in your city, make sure to hit that subscribe button and give this video a thumbs up, because today we're dissecting the rent versus buy debate using real 2026 data. And I'm telling you right now, what you discover might completely change your 5-year plan. Let's get straight to the point. Here's the lie. Renting is flushing money down the toilet. When you buy, every payment builds wealth. Homeownership is the foundation of financial security. Sounds reasonable, sounds adult, completely incomplete. Because here's what they strategically avoid mentioning. When you own property, you're also flushing money down the toilet every single month. You're just flushing it in ways that sound more respectable at dinner parties. According to 2026 housing affordability reports, renting has become a legitimate wealth-building strategy in high-cost markets rather than a temporary stepping stone. And there's cold mathematical proof to back this up. But let me break down what you're actually paying for when you think you're building equity. When you own property, you have 4 major costs that evaporate forever, exactly like rent. These are the costs the homeownership propaganda machine never wants to discuss. Cost number 1, mortgage interest. In the first decade of a 30-year mortgage, you're paying predominantly interest, not principal. At 6.8% on a $323,000 loan, you're paying roughly $1,830 per month in interest during year 1. That's money you'll never see again. You're not building equity with interest payments. You're compensating the bank for lending you money. Cost number 2, property tax. You own the property, but you're still paying rent to the government based on its assessed value. In the United States, the average property tax rate is approximately 1% of home value annually. On a $380,000 condo, that's $3,800 per year, $317 per month evaporated permanently. That's not equity. That's the cost of being allowed to keep what you supposedly own. Cost number 3, maintenance and repairs. Financial advisors recommend budgeting 1% of property value annually for maintenance. On a $380,000 property, that's $3,800 per year, $317 per month. The water heater that dies, the HVAC that fails, the roof that leaks, the plumbing emergency at midnight, this money vanishes. You're not building wealth by replacing a broken dishwasher. You're preventing your asset from deteriorating. Cost number 4, the opportunity cost of your down payment. This is the invisible wealth destroyer that nobody explains clearly, so listen carefully because this is where the 5% rule originates. Your capital has alternative uses. When you put $60,000 into a down payment, you're choosing not to invest that $60,000 in index funds, where it could compound. Historically, the S&P 500 has returned approximately 10% annually over the long term. Meanwhile, real estate historically appreciates around 4% per year. The difference, roughly 5 to 6%, is the opportunity cost of locking your money in property instead of liquid investments. Let's calculate the total unrecoverable costs. Property tax, 1%, maintenance, 1%, opportunity cost, approximately 3% after accounting for the fact that most of your money is financed, not paid in cash. Combined, approximately 5% of the property's value annually. This is the 5% rule. To determine how much homeownership actually costs you monthly in unrecoverable expenses, take the property price, multiply by 0.05, divide by 12. That's your break-even rent. Can you rent for less? Drop your calculation in the comments. Now let's examine what's actually happening in 2026 because the numbers are absolutely wild. Mortgage rates are averaging 6.7% for the year according to Freddie Mac projections. That's slightly better than 2025's 7.1% average, but nowhere near the sub-3% rates everyone still uses as their mental baseline. United States mortgage rates are expected to stabilize around 6.5 to 7% throughout 2026, based on Federal Reserve policy forecasts. Some optimistic scenarios suggest brief periods below 6.5%, but sustained low rates aren't projected for years. And property prices? The National Association of Realtors expect home prices to increase 2.6% in 2026, while CoreLogic predicts 2.8% growth. Properties are getting more expensive, rates remain elevated, and affordability is at multi-decade lows for first-time buyers. But here's what's happening with rents. According to Rent.com and Apartment List data, rental price growth has dramatically slowed. Many markets saw rent decreases in 2025. Nationwide, rents are projected to increase roughly 2% in 2026, barely above inflation. That's sustainable. Meanwhile, homeownership costs are locked in at whatever rate you secure today. Look, I'm not claiming buying is always wrong. I'm claiming it's wrong right now for most people in most markets unless specific conditions are true. Buying makes sense when you're committed to staying 7 to 10 years minimum. Transaction costs destroy short-term buyers. The 5% rule calculation works in your favor. Monthly ownership costs are substantially lower than comparable rent. You have a substantial down payment, 25% or more. This dramatically reduces your mortgage size and opportunity cost. Rates fall to 4.5% or below. At 4% mortgage rates, the math shifts favorably towards buying in many scenarios. You value specific intangible benefits enough to pay a premium. Stability, customization, control. These have value, but they cost money. But here's what you need to hear. Assuming a 7% annual return on invested capital, renters who invest the difference often accumulate $150,000 to $200,000 more wealth over a decade than equivalent homebuyers in current market conditions. Let me say that again. Over 10 years, disciplined renters who invest what they save can end up $150,000 to $200,000 wealthier than homeowners in similar properties. That's not a rounding error. That's retirement money. Now, homeowners reading this are getting angry. But equity, but appreciation, but tax benefits. Let's address these systematically. But I'm building equity. You're also paying massive interest. In the first years of a 30-year mortgage at 6.8%, the vast majority of your payment is interest. You might be building $300 to $400 monthly in actual equity initially. Meanwhile, the renter investing that cost difference is accumulating actual liquid wealth that doesn't require selling an asset to access. But it's forced savings. You know what else is forced savings? Automatic investment transfers. Set up an auto transfer from checking to a brokerage account on payday. Congratulations! Forced savings without the illiquidity, transaction costs, and concentration risk of property ownership. But tax deductions. The standard deduction is now $14,600 for single filers, $29,200 for married couples in 2026. Unless your mortgage interest significantly exceeds that, you're getting zero tax benefit. And even if you do benefit, it doesn't offset the opportunity cost and transaction costs of ownership. But rent increases every year. So do property taxes, so does insurance, so does maintenance. Your mortgage principal and interest is fixed, but your total housing cost absolutely rises with inflation.